Using the budget builder starts with deciding the first month of your plan. So assume this one starts in September. We go to revenue, and you can have up to 3 product lines. We're just going to have one in this company, and it's going to be the ubiquitous widgets. So we have previous year totals in this column, 12 months of the business plan. Then if you wish, you can go up to 4 additional years, one number for each year. We're just going to do the previous year and this year. So this company last year sold £1 million worth of widgets, spent £600,000 on materials. Just to keep it simple, I'm just using this one direct cost. Clearly all of these work exactly the same way. It spent £200,000 on salaries, £5,000 on marketing, and £120,000 on rent and rates. It's giving it a profit before tax of £75,000. So the budget for this year, got growth on the revenue line of 27%. You can see that here. And growth on materials of somewhat less. I mean, the only line we've got of direct cost is materials, so materials 21% increase. So top level summary of this particular company budget is significant sales growth and managing direct costs, material costs, to grow rather less. So that's all nice, and the result is an increase in gross profit and gross margin. So last year gross margin was 40%. This year company's forecasting 43%. So salaries. Again, we're not going to fill in the details here of the rest of these indirect costs, but just looking at salaries, you have a 34% increase in salaries, and you can see it looks as if the company is hiring another person in February. So interestingly, the growth in revenue is 27%, and the growth in salary costs rather more. So that's something that needs probably an explanation somewhere in the plan. Marketing. So you can see a significant increase in the marketing spend. Possibly that links to the increase in sales. And there's a rent or rates or some kind of accommodation cost increase in November. So our total indirects, or this company's total indirects, are going up 25%. Net profit is rising from 8 to 11%. So 8% last year, 11% this year. And we're going to assume the company starts off with £100,000 cash, and it needs to pay corporation tax at some point, and let's say it's going to pay a couple of dividends. So we can see that we've got a healthy increase in the cash balance with the plan as it stands. So just to run through how we use this to create a budget, we start with revenue. Then we add in direct costs, which are generally around labour and materials. That gives us our gross profit, gross margin. When we add these numbers, when we put the previous year and the current year numbers in, it tells us what increase or decrease that represents. So once we've got the gross profit, we add in our overhead lines. Again, I've only used 3. You can use as many of these as you need. And that then gives us net profit, and again it tells us how it's grown, and it tells us what that represents in terms of an improved or declined profit level. Finally, we turn this into cash flow. So at the way this model works, it doesn't have the facility to delay income, so it assumes if we invoice £100,000 in September, that we get paid in September. Of course, in the real world, that isn't the case. But this is a simple model, really, just to get you started with the budgets. This assumes payments in and out happen in the invoice month. So, having put the budget together, there are some things we need to explain. Product revenue growth. I'm just going to really quickly put in more marketing. That's how we're going to generate this growth. Now, clearly there's more to it than that, but that's just to illustrate the point. Changing gross margin. We look at our change in gross margin. It was 40, gone up to 43. How have we achieved that? Well, we've taken our materials cost and grown it relatively more slowly than income. So in some way we're being more efficient with materials. How do we think we're going to do that? Well, possibly we've got better volume deals with suppliers. More efficient stock holding. Both of those feasible in a growth scenario. If we've got our overhead growth, 325 plays 405, so it's gone up 25%. Where has it gone up? Well, we can look at this and say, actually, well, we can see that our employment costs have gone up here, and we can see the rent's gone up here, but we see also our marketing has shot up. So here's our narrative. Overhead growth. Marketing cost. Extra, I don't know, engineer. Rent increase. And if we look at our net margin, which is improved from 8 to 11. We've really covered the explanation above, so see above. Okay, so there it is. That's a very simple way to build a budget.